Your parents worked hard. They saved. And there's real money coming your way at some point. But here's the thing no one is telling you. The rules of how that works have completely changed. I'm not talking about estate taxes. Most of you will never hit that threshold. I'm talking about something that's going to affect almost everyone who inherits a retirement account today. You might have heard of this as the Great Wealth Transfer, and it's about to be a big event for a lot of people. In this video, I'm going to explain what changed to get us here, why it matters more than estate taxes for most families, and what we can do about it. Whether you're the one who might inherit money or the one who's going to leave something behind, we're going to talk about the old rule versus the new rule, why it's not actually an estate tax, a conversation to have with your retired parents, and what to consider if you're going to leave an inheritance. So let's talk about first the old rule versus the new rule. We're entering one of the strangest inheritance eras we've ever seen in terms of how much money is transferring and how the tax rules are going to apply for everyone who's receiving these assets. A lot of families are starting to discover that inheritance doesn't always look the way previous generations had expected. Before the Secure Act of 2019, you could stretch an inherited IRA over your entire lifetime, taking small distributions and letting the rest of the money continue to grow for your future needs or for additional generations down the road. Now, if you're a non-spouse beneficiary, you have 10 years to drain those inherited accounts. It's a completely different tax picture and potentially hundreds of thousands of dollars an additional ordinary income that you have to pay taxes on. So what that means is if you have a retirement account that's going to go to children, siblings, grandchildren, really anyone who's not a spouse or a qualified charitable organization, this is something you need to be thinking about. Otherwise, those people are going to get stuck with a giant tax bill. And the real challenge of that is whatever they have to take out of that account, it gets added on top of all of their other income sources and oftentimes pushes their tax bracket much higher. Think about this. If you're in your 80s and you pass away and your children are in their 50s at their highest earning years ever, they're going to receive those inherited assets on top of their highest earning years. So if they're already making $400,000 a year, they might have another $400,000 a year they have to take out of those accounts and pay tax on, depending on how large your inheritance is you're leaving to them. That can be detrimental to their entire financial picture and really detrimental to the legacy you're able to leave for your family and future generations. So we talked about the difference of the old rule and the new rule. Let's talk about why this isn't exactly an estate tax. Now, yes, I know we're calling this the new inheritance tax, but we got to be very careful with this. This is not the same as an estate tax. Estate taxes only kick in for very large estates, currently over $15 million per person. But the 10-year rule on retirement accounts hits anyone who inherits a pre-tax retirement account, regardless of their wealth level. A $400,000 inherited IRA from a parent who saved well is a real tax event for a 45-year-old in their peak earning years. This is not an estate tax problem, and you don't have to be wealthy for this to hit you hard. That same $400,000 inherited 401k added on top of your salary could push you into the highest tax bracket in any single year. This is not exactly an estate tax problem. You don't have to be wealthy for this to hit you hard. If you inherit a $500,000 401k on top of your regular salary, this could push you into the highest tax bracket. It can also be detrimental for those in lower income brackets already with lower inheritance amounts. If you're accustomed to being in the 12% marginal tax bracket every single year and your family passes down $300,000 in an account and that pushes you into the 22% bracket, that can have detrimental effect for your overall tax position and in some cases push you out of certain tax credits that you've been counting on every year. So if you are inheriting assets, here's a few things we need to make sure to consider when we think about planning proactively to minimize the impact. Let's talk about Roth conversions. If your parents are between 60 and their early 70s and in a lower tax bracket than you'll be, this is the window where converting pre-tax to Roth assets before they pass might allow them to pass on all their wealth tax-free. It's one of the most valuable moves available, and most families never discuss it. Another strategy is using creative charitable giving planning. What that means is if you have different types of investment assets or different types of tax status on your investments, we can choose to draw assets from different buckets to be more tax efficient for while you're living and pass other ones down in a more tax efficient way to your heirs. Combine this with making strategic charitable contributions to qualified 501c3 organizations, and you can actually make the majority of your estate tax-free, if not all of it, over several years' time. So what if you're the one leaving the inheritance? If you think you're going to leave an inheritance, there's a few things you need to start thinking about today. Don't just accumulate more assets. Let's think about what we're handing off. A big pre-tax retirement account is a long-term tax liability for your heirs and your legacy. Consider the mix: Roth, taxable brokerage, and life insurance. The vehicle matters just as much as the amount. The best thing you can do is to be proactive with your planning and develop the right strategy to make sure your legacy is one that is positive and well remembered. Most importantly, the legacy you really leave is not just about the money, it's about the way of life, the perspectives, and the rhythms you leave that people will recreate and use to remember you going forward. The great wealth transfer is happening whether you're ready for it or not. An estimated $90 trillion is moving from one generation to the next, and let's be honest, that number climbs every single day. Whether you're sending it or receiving it, a little planning now changes the outcome dramatically. The conversation to have isn't about estate taxes, it's about what vehicle the money is sitting in and whether you've got time to do something about it. But most importantly, for a lot of families, most families actually, it's not even about inheritance at all. It's about how to care for each other and have the right conversations while still planning wisely today. If this video has been helpful, make sure you like and subscribe because we post videos like this every couple of weeks. You can find a few more of them here below. We'll see you at the next one.